Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Justin Carbonell and Jack Forehand are principals at Validea Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital or Sunpoint Investments.
So Matt, we had Rick Ferri on excess returns last week, and it's actually been it's going to be one of our most viewed episodes of all time. Which is very interesting because he just basically talks about having a very simple approach to investing. You know, we've had all these complicated guests and, all this stuff, these advanced strategies we've talked about. But his first episode with us before this one is our most viewed episode of all time. And this one's on track to be up there too. So obviously people like the simple.
Let me just say, Rick Ferri stan, and I mean that in the truest sense of keep it simple, stupid, which is basically why I'm a Rick Ferri stan, and I'm going to take it there. I've got a challenge for myself on this episode. I am doing the Rick Ferri, Paul Stanley, not just Paul Stanley, but all-round KISS, Keep It Simple, Stupid playlist as we go. We got some points on him. I'm doing the KISS playlist. I'm committed.
I love that. Yeah, it's with me, it's spouting out all this boring stuff about factor investing and whatever the whole time. It's going to be a good contradiction to that, I think.
But it's so good. Rick Ferri, whatever you think, wherever you fall down on this, he will force you to think and talk about stuff with a clarity that very few people in the financial, I don't want to put him in the punditry space, but like for advisors, people like Rick Ferri are critical. For asset allocators, people like Rick Ferri are critical because they're going to hold a mirror up to your thinking and they're going to say, like, what do you really think about this and why? Defend that position. Even if you don't always agree with him, he's going to make you defend that position. I have so much respect for him and his work and the clarity of his thinking. And hey, what better ground to prove this on than if we're going to keep it simple, stupid? Nobody did it like KISS.
Yeah, so I probably should have said this at the beginning, but the theme of the episode today is we're going to talk about some lessons from Rick Ferri because I thought it was interesting. Like, it's one thing to have these guests explain what they do and their thoughts on all these things in investing. But for you and I, like, I come from like the investing side of things. You come from the planning side of things. There's so much we can build on these lessons in terms of how we think about it in the real world. So this is something we're going to try with some of our episodes. And I think the Rick one was a great one to start with. So we're going to talk about the biggest lessons we took from the episode with Rick.
I love this idea. And again, you're holding up a mirror. So whether you're a professional investor, you're an allocator, you're a do-it-yourselfer, you're an advisor, wherever you are in the mix, listen to the Rick Ferri episode, Excess Returns. It's on the YouTube. I'm sure we'll have links in the comments and after the video or during the video. But just let this be the mirror that you're holding up to what you're doing and answer honestly back. It's so good. Jack, you were so kind as to put together, you did the hard work here. You helped put together some of these ideas when we went back and forth on this. Take us through them. Start us at the top.
And I think the first thing to say is I think some people, like including me, would watch an episode with Rick Ferri. I am a factor investor. So what we do is something that is different than the market. And some people might say, well, you and Rick Ferri have nothing in common. Like, why would you want to listen to Rick Ferri? Rick Ferri is indexing. Rick Ferri is low fees. But the reality is a lot of what Rick Ferri says is correct. And a lot of it actually is grounded in what we do as well. Like, there's such this tendency to say, I do this type of investing. So this guy that has a different opinion than me, where I'm not going to talk to that guy, or I don't want to like learn from that guy. But one of the things we try to do with the podcast is always get people who think differently than us. And what you realize is probably if I was to align what I think about investing with Rick Ferri, it's probably like 80 or 90% aligned. It's around the edges, maybe around how you use factors or how well they work or why they work. I mean, there might be some differences there. But the reality is I'm pretty grounded, in terms of what Rick Ferri says. I mean, I'm a believer that all else being equal, you want to invest in lower fee stuff. I'm a believer that a lot of people should be indexing and not doing active things. Although I think many people, can benefit from active things. So I think there's so much in common there. And, we tend to get trapped in this, well, this person is an active investor and this person is a passive investor and, so that they can't work together. But a lot of the lessons are kind of timeless no matter who you are.
Couldn't agree with that more. And I guess I'm going to keep saying it, like, let it hold the record, the mirror up to what this is. Let him put it down. Let him put the record down of like, this is what he thinks and why. But then what I think most people would find out is just how much they agree. then I'm with you too. I'm like 80% in agreement. I'm not 100% in agreement, and there's little implementation things, but that's also one of his subpoints. Like, you have little bits in your implementation that you're going to go and do a different way. I don't think he would begrudge a person for doing that. And the basic tenets of what he says of like, hey, if you're going to pay extra for something, know what you're paying for. It's hard to quantify. It's messy, but like, know what you're doing and why you're doing it. And if you can square back to that over and over again, it makes a heck of a lot of sense, and it's easier to stick to.
So my first lesson was favor simple over complex. Most of the time I had in parentheses. And I think this is a really important lesson no matter what you do. Like, obviously at a really basic level, simple is indexing, and simple is, just a few funds. And that's what Rick was talking about. Like, he was talking about the evolution of an index investor, how where you start with these complex strategies, you get to indexing, but then you probably own too many indexes. And then eventually you get to, your 3 or 4 fund portfolio with your indexes. And so that was the evolution of an index investor, but I think it works everywhere. It works with what I do. Like, there's a tendency when you're running factor strategies to say, oh, look at these advanced tests, and I need another thing to try to filter out, these bad companies, and then I need another thing to do this. And like, a great example of that is Wes Gray, who we probably respect more than anybody else in the factor space. Like, when he wrote Quantitative Value, he had sort of his value strategy, but then his systems to like filter out the bad companies were incredibly advanced. Like, I remember we tried to program them for Validia, like tried to program that strategy. And like, I had like 8 pages in a Word document of what I had to put in, like for all these different, Z scores and whatever else it was. And I'm like, this is a huge lift. But Wes has evolved over time, and he's realized he can accomplish that same thing with a much simpler series of tests. So now Wes is doing the same thing, but he's doing it in a much simpler way. And I think that's why this is not just about index investing and running the simplest portfolio. It's about, even if you're in our world, we tend to think, oh, I'm so smart, let me overcomplicate this strategy. But the reality is, if you take this simple thing and you carry it all the way through, it works almost anywhere.
The beautiful part about keep it simple, stupid is not to call anybody stupid or not to belittle the idea of simple. You can have, and Wes is a great example for this, you can write the code to do this thing, but then find out after you've done it for a while that it's hard to implement, that it's hard to actually carry out all those things, or it's hard to replicate, or it's hard to whatever. And you have to think about, in actionable terms, what's the thing that I am going to do, and turn it into something actionable that I can actually stick to. The note I made to myself on this one, it always makes me think of Joel Greenblatt in the all broccoli diet example. It's like, if you hate broccoli, why would you decide, and you need to go on a diet, why would you then decide to go on the all broccoli diet? That's a bad combination. Now, you have to be realistic. You can't do the all chocolate cake diet because you really love chocolate cake. But the all broccoli diet is one of those things. Unless you love broccoli, there's other ways you can do this. Keeping it simple, favoring simple over complex, is basically you saying, how do I reduce this thing down to something that I can actually stick to, follow through on, and understand?
And the second part is the most of the time. And I think that's important too, because you can't always have hard and fast rules in investing. And so, for instance, Matt, I don't think the guys who run the Medallion Fund listen to our podcast. It would be, I'm probably going on a limb there, but I think they're probably not listening.
You never know. You never know.
Yeah.
Medallion,
Yeah.
drop us a comment. Send us a message.
But if they are, they're probably not being like, you know what, we need to simplify our investing system right now, because these guys are saying simple is better over complex. Like, in their case, complex is probably working out pretty well. So they probably should go ahead and stick with the complex. So it's not like, there's certain things that have to have some degree of complexity. Like, if you're a believer in managed futures, like, and their value to a portfolio, especially as they become, available via ETFs, like there is some degree of complexity to running a managed futures portfolio. You can't just say, like, I need to simplify this thing, and like, I should just have these index funds. There's a case that managed futures adds a lot of value to a multi-asset portfolio, and that requires a degree of complexity. So it's not always simple over complex, but I think if you have that rule in the back of your mind, like you were talking about the mirror before, if you're always asking yourself, could I do this in a more simple way? I think that's the lesson.
The what works most of the time part for you. That's the redirect back. You can go out and do managed futures and all this complicated stuff if that's what works most of the time for you with your personality. Dieting, and maybe broccoli's not your favorite thing, but maybe once in a while you spice it up with a little asparagus or something. There's nothing wrong with finding these little variants, so long as you keep going back to what works most of the time for you specifically, because at the end of the day, you're the only one who can do anything with this. Now, as the reminder, so my KISS song for this idea is, I got to go back to the magic of KISS, keeping it so painfully, intuitively simple that the metaphor is barely hidden. This is the beauty of KISS, because there's just no hiding. Well, no place for hiding, baby. No place to run. You pull the trigger of my love gun. You don't need much more than a middle school education to get what that means. Favor the simple over complex. Most of the time, it can get you places.
I like that a lot. So the second one is, I think this is really interesting because we've been hearing a ton now about the 60-40 portfolio is dead. And I think there's a lot of nuance to that argument. So Rick defended the 60-40 portfolio and defended the fact that you probably don't need commodities and this other stuff. And so I think that's a really nuanced argument from this perspective. There's two different questions here. One question is, could you potentially enhance the 60-40 portfolio like as kind of an all-weather strategy with something in it that could help you in an inflationary environment? The second question is the 60-40 portfolio dead? And this answer to the second question is clearly not. Rick is right about this. The 60-40 portfolio is not dead. If you're somebody who's just going to take your portfolio, you're going to buy and hold it for the long term, you're not going to worry about the inflationary periods, stocks are going to probably have a risk premium. Bonds are going to have a risk premium. You're going to probably do fine. Like, you don't need to listen to people like me who are like, well, I've done my testing on Portfolio Visualizer, which by the way doesn't exist anymore. And I've shown these, I've shown that this is a more efficient portfolio. I think those arguments can be correct, but it doesn't mean that the 60-40 portfolio is not a perfectly fine portfolio for a lot of people. You know, if you are the person who's sitting here during this inflationary environment where it had that bad year in 2022, and you're like, all right, you know what, that's part of the long-term deal. I know what I got myself into. I'm going to stick with it. That's fantastic. The 60-40 portfolio is fine, and Rick is right. So I think that's what I took from that is that there's a nuance to these arguments. Like, you can't take the idea that there are some flaws with the 60-40 portfolio and carry it to the 60-40 portfolio is dead. And I think a lot of people make that mistake.
At the end of the day, the 60-40 is about two asset classes. You can do the 25-25-25-25 of, you know, stocks, long-term bonds, short-term bills and cash and like gold or whatever.
Permanent portfolio type thing.
Permanent portfolio type thing. You can do a million of these variations. Back to the first observation, rule number one here, like, keep it simple, stupid, do something that you can stick to and implement over time. If one of those other things makes sense to you, go for it, so long as it makes sense. Something in this interview, he says, I don't know how many times he says it, but he definitely says it more than probably once or twice and probably more than like 3 times. He talks about how like earnings drive the stock market over time. And I think this simple idea in the 60-40 of that you have like earnings driving stocks, and whereas he doesn't say this, but you have like term and rates and maybe credit risk driving like bond returns. This right here is a basic tenet of diversification. You have 2 different return drivers that are kind of related, but they're not totally correlated. And that means as a complementary aspect, these assets pair pretty well together. And then on top of that, the growthier bias that you get with the 60-40 portfolio, because most of your risk ends up on the 60 side. I forget what the stat is. What is it, like 80% of your risk or 90% of your risk comes from your stock allocation, whatever that is. You're still giving yourself away where it's like some of this is going to zig when some of this stuff zags. I have room to be flexibility that isn't just dependent on the cash flows in or out of my portfolio. And there's a reason it works. We can shoot a million holes in it all day long, but the track record's kind of hard to argue against through multiple regimes for some pretty cool reasons. I think that's a really respectable thing.
Yeah, the other argument I would make in favor of the 60-40 portfolio is the behavioral one, which is when you put these other things in there, you look different. And that can be hard for a lot of people. And so you end up in this trap where you're effectively, oh, I've seen inflation, let's put the commodities in. And then suddenly the commodities don't do well. So now the commodities are back out. And so like a lot of times, even if there are flaws in the 60-40, and even if you look at that quadrant of the different economic outcomes and say inflation is a big weakness, you still probably behaviorally, it's very tough for someone to stick with these all-weather portfolios. And Eric Crittenden, who we have on the podcast this week, does a good job in that he starts with a base in what he does of the 60-40, and then he kind of overlays this other stuff on top, so you still get your 60-40. But I think there's a huge behavioral argument to be made that even if in theory, some of these other portfolios might be better on my risk and return stats, like behaviorally, the 60-40 might be easier to stick with for people because that is what they judge. Their neighbors are in the 60-40. They judge themselves against that. It might be better just to be in that.
That basic tenet of you actually can understand it is just going to come up again and again and again. This is part of why even when we're dealing with complex arrangements of lots of like private equity or private asset classes, things like that, private real estate, all the other stuff that would convolute the way we think about a 60-40, we still try to reduce that down to risky and risk mitigation assets. And guess what? Even most of those benchmark models end up in kind of a combination of a 60-40-ish mix between things that we would call risky and things that we would call risk mitigation. We're still trying to reduce to that basic idea of here's two things with slightly different drivers of returns and ways to think about them and how they lay into your broader portfolio.
So you have a 60-40 song?
I got a 60-40 song with some two basic diversification tenets, and that's Detroit Rock City. Because you got get up, everybody's going to move their feet. Get down, see diversification. We got up and down. Everybody's going to leave their seat. You got to lose your mind in Detroit Rock City. Don't lose your mind in Detroit Rock City without a 60-40 portfolio, at least as your benchmark comparison. I think that's a lesson even Paul Stanley would get behind.
I think you would love this episode, probably. So number 3 is assume the efficient market hypothesis is mostly right. And this is an interesting thing. So the efficient market hypothesis, basically, we're not going to go through all the details of it, but the idea is if I'm a believer in that, then the way I'm going to get a better return is I'm going to take more risk. And so there's a way to view like what we do, factor investing. You know, there's the two arguments. There's the risk-based argument that it works, that because you get better returns for something like value because it takes more risk. And then there's the behavioral argument, which is there's some sort of, mispricing created by behavior. Rick is a believer in the first. So we'll talk about factor investing later, but the idea is factor investing works in the efficient market hypothesis as long as you believe that it's risk that's driving it. But the bigger idea here is there's a lot of people out there that are pricing assets on a daily basis. They're very smart. They've got very powerful computers. If I'm going to do something different than the market, I probably should have some really, really compelling evidence to believe that it's going to work. And so I think if you start from the position, even if you don't believe the efficient market hypothesis completely, if you start in that place, and then when you're doing something else, you try to figure out, all right, well, if I have a risk-based argument, I can still believe in the efficient market hypothesis and I can do this. And if I'm doing something and I don't have a risk-based argument, I better have a compelling evidence to suggest why I think it's going to work. So I think that's how you can get around, even if you don't believe in the efficient market hypothesis, I think that's how you can learn from people like Rick who do, is that it raises the bar. Going back to the mirror thing you were talking about before, it raises the bar of what I'm doing, and it makes me make sure that if I'm going to do something different, I really have a strong conviction in what I'm doing.
You have to have a reason to disagree. That's what the efficient markets hypothesis, even if you're not going to say this is my one true religion, you still have to have a reason to disagree with it. And that's inviting the opportunity to say like, yeah, guess what? You kind of should, because your portfolio, I've said this a million times, like no matter what, like you taking money in and out of a portfolio, saving money or then living off of stuff, those are active investing decisions. You should understand the math of active management, because even if you're just buying and selling an index fund over the next 100 years of your life, you have active decisions to make around your passive vehicle that you're selecting. So the efficient markets hypothesis is really important. You can pick your spots where you disagree with it. You have to ask the question. The mirror in this case is saying like, hey, fees, frictions, other things, do you still think and why you can be better than this idea with these insights? Like, do you have enough insight that's better than the friction of the cost of putting this trade or putting this idea on, that you're not going to eat it in some other way? And if you do, it's okay to disagree. It's okay to have that, what you think is an informational edge or what you think is whatever. Again, we don't want to get too deep in the weeds on like how that's calculated, but we are going to say, pick your spots to disagree. There's real power in picking those spots of differentiation for your strategy.
Yeah, I think so. And I think so. I think the efficient market hypothesis is something that, I think most people understand it. It's something that you should always have in the back of your mind, I think, as you do these things. And just thinking like, if I'm going to do something different, then let's have some reason I'm doing it. And then let's not, like, people like me tend to get in this trap of thinking like, oh, I've got to challenge the efficient market hypothesis. And like, I have to, if I'm an active investor, I have to attack it and stuff. And I don't think that's right. I mean, I think there's a lot you can learn from the efficient market hypothesis, even if you don't believe it's completely true, even if you don't believe in the strong form or the semi-strong form or whatever various other forms of it exist. What's the song?
Kiss playlist song number 3, Calling Dr. Love. Because calling Dr. Love, they call me Dr. Love. I mean, come on. Is he a doctor? You know he's not a doctor. This is a grown man in makeup declaring to be the doctor of love. There's no PhD dissertation involved in this doctor declaring this thing, but you know what it means. So you gotta pick your spots where you disagree, and that goes in both ways. A bold claim, like declaring yourself the doctor of love, or just admitting, hey, medicine's got some of this stuff figured out. I'm going to be okay with things like the efficient markets hypothesis.
So this next one I think might be the most important thing we talk about. And we talked to Rick about this at the end. We had kind of brought it up from a different perspective, but he thought about it from a perspective of asset allocation. But the lesson is the same no matter what. And the idea is, if you play a role in creating your investment strategy, or the corollary is, if you invest in what you personally believe in, you're going to do better. And I think, where I always think about this is where the world we live in factors. There's a lot of different types of factor portfolios you can build. And there might be, let's say, the optimal factor portfolio where I've got each, factor weighted. This doesn't really exist, but I'm just giving you as an example, like where I've got each factor weighted properly. And I've really built the portfolio that I think in my testing is the best thing Jack can build. But what I've learned over my career is that portfolio that's the best thing Jack can build is not right for a lot of people. And the reason it's not right for a lot of people is because they have personal beliefs in terms of what works. And so a good example is like someone we've worked with recently is a big believer in investing in dividend growers. And so if you're a big believer, and that's a great strategy, investing in dividend growers, you actually you end up getting at high quality companies sort of indirectly by buying these dividend growers. So that's a great strategy. And even if I go in my test and I run, my A/B test on Portfolio Visualizer, and I'm like, well, here my multi-factor strategy has a better Sharpe ratio than dividend growers. It's a meaningless thing, because that person who believes in dividend growers, they're going to keep investing in those dividend growers. When the dividend growers aren't working, they're going to stick with the dividend growers. And I think that's such an important thing, is what you believe in is so important. And if you can play a role in like working with me, I've found, like if you have gone to me and said, I want to invest in dividend growers, and you've had a hand in how we construct that strategy for dividend growers, you are far more likely to stick with it. And so I think this might be the most important thing, because we tend to get trapped in theory and investing and not in practice. And in practice, it's all about what can you stick with for the long term, even if maybe you give up, the 0.5% of long-term return or whatever it is. Like, I think that's such an important point.
I love the way you just explained that, and I love the way that Rick actually put a spin on this idea, because it comes at it from a point of agency. It comes at a point of realizing you're different, but it doesn't just stop at do what you believe in, you're different, you're special, ignore everybody else. It also makes the point, as you just did, and I believe in this wholeheartedly, not only are you different, but then the other people you're working with, they're different too. Like, I have my agency, you have your agency. If I'm hiring you to do an allocation strategy for me, I'm talking with you about the things you can do that I can't do, and the things that I can do, like save my money or whatever, that you can't do. You can't go to work and save my money for you. Can you? If you can do that, can we have a conversation? I don't think that's going to work. I don't think it's going to work. This sense of agency, though, becomes really, really important, because whenever there's a conflict, it's always because somebody else is, or not always, it's usually because somebody else is overstating or taking away the other person on the other side's agency. So it's really easy for me to get upset at, big firm or big active manager and high fees and all this stuff. And if I haven't done anything about it, I can just put all that blame on them. Now, if I didn't know, and people do stupid things all the times, it might just be one of those things where, like, I didn't know and I got swindled. But once I'm aware, once I have agency of choice, I can get away from that thing. Now, likewise, you can be in a situation where you have two people in a relationship, in a advisory business, in a planning business, and whatever else, or even just me and Vanguard on the other side, if you want the extreme passive investing example, where we can say, I've preserved my agency, they've preserved theirs. Here's something that's mutually beneficial at whatever the cost differential is. And if that's true to you and it's true to the other people you're working with, that's the best we can do as humans. That is the best we can do as humans in relationships.
This is such an important point, because one of the things I've learned is when I build an investment strategy, when someone says to me, build the right strategy for me, and I just build it and give it back to them, what happens during the inevitable periods of struggle? Jack is screwed up. Jack has built the wrong strategy. I doubt Jack and his ability to construct this strategy. Now, if we've worked together and we've built this dividend grower strategy, and you know what's going into it, and you understand that it matches the way you want to invest, now I have also, I'm going to look at this period of struggle completely different. Now I'm going to look at it as, I believe in this strategy. We worked together to build it. I am going to stay the course. And that's so important, Because who cares about whether Jack is right or wrong? Like, you can judge me all day. That's fine. What I'm trying to accomplish is you stay with your strategy. Even if you attack me all the way, the whole way along as you do it, that's great. Like, you've got to stick with the strategy. And that's where this is so important. If you've played a role, you are so much more likely to do it. And so I think this might be the most important of the lessons we talk about. And I assume there's a Kiss song also that
there's definitely a Kiss song for this. And I'm putting the extra highlighter on the great part about that too, about especially when you're paying somebody for advice in some form, is this is what forces you to extend the time horizon, and it forces you to take ownership in some of that decision, not just push blame onto somebody else. That's really important in both directions. And both sides have to be comfortable with that type of stuff. So there's this Kiss song, God of Thunder. You may or may not be familiar with this. Does this one ring a bell? Okay, so this is like broadly regarded as Gene Simmons' theme song. One of my favorite parts about this song, it's kind of a creepy song, I'm going to be honest. But Paul Stanley wrote the song, and he was originally supposed to sing it, but the producer basically looks at him and is like, no, this is a Gene song. And it becomes basically his theme song. He owns it all the way through, but it's a real message of like, in you do you. So when Gene is singing, I command thee to kneel before the God of thunder and rock and roll, that's conviction. I'm not finishing the line there for very deliberate reasons. Because like I said, it gets a little creepy. But that level of conviction, that sense of agency, of being in the band, of Gene taking the song from Paul, but Paul's yielding to the producer and going, no, the best service to this song is when Gene sings it. That's a really powerful thing. That's preserving agency. That's playing a role in your creation all the way through to, you know, making an iconic theme song for ultimately a character.
So number 5 is another great one, which is match the time frame and strategy works over with the time frame you judge it over. And we talked with Rick a lot about this, and this really, value investing is the greatest example of this right now because we're all seeing it, which is this idea that, you know, when you go to an investor and you say like, how am I to, they start investing with you and you say like, how are you going to judge this strategy? Well, they're like, well, I'm a long-term investor. You know, I'm going to stick with this over the long term. And then you say to them, well, what is the long term? And they're like, yeah, you know, 3 years, give or take. And the reality is with these types of strategies, it's not just a factor investing thing, like with active managers that are picking stocks, whatever it is, like all these great guys, Buffett's had huge periods of struggle. Like the actual period you can judge these strategies over is very, very long. I mean, Meb Faber's talked about it being as long as 20 years. And if you think about that, and then you pair that with how long can someone stick with a strategy that doesn't work, you have this massive disconnect. And so it's very important for people to understand, first of all, Rick talked about this in the podcast. You can deal with this to some degree by how you weight these things, how you position size them. So if you take something that can have long periods of struggle and you take a smaller position in it, it's going to be less painful for you. But if you're taking the bigger positions, or even if you're taking the smaller positions and you're going to judge it, it's really important to think, like when I get in this situation where this thing has the 3 to 5 year period where it doesn't work, or even a longer period than that, what am I going to do? Because if what I'm going to do is abandon the strategy, then I shouldn't be at it in the first place. Whatever that active bet was, I should make that active bet. And I think that's really important. And it really relates to my world where people are deciding whether they want to make bets on factors. I think bets on factors are great things to make, but I think you've got to be the right person to make that bet.
We've talked about this a lot on this podcast. I love this analogy of making sure you have your calendar, your cash flow, and your balance sheet and everything you do. And the reason you need that calendar, cash flow, and balance sheet is because it's a forcing exercise to not just have the calendar, this is the whole time frame thing, but then to be matching the cash flows against the calendar and the balance sheet against the cash flows against the calendar. If you're going to do something for the long haul, if you're going to save into stocks, if you're going to save into stocks inside of an IRA, save to stocks inside of a Roth IRA, save to stocks into a trust, put money into a house, put money into an investment property, put money into some sketchy commodity strategy that your roommate from college started, whatever the circumstance is, you got to match the cash flows against the balance sheet and map it back over the calendar. When you start to do that, when you start to have a genuine financial plan that you've built and constructed, now you can start to make sure, is this thing on the balance sheet supporting my cash flow needs over what period of time? And it can support it in the saving direction of going in when I have a surplus in my cash flow and my savings and where it can go. And it's doubly, triply, quadruply important, especially during downturns, that balance sheet supports the cash flows on the way out so I don't run out of money. It's a really basic concept, but it means in investment strategies, giving it time to work. It means in a financial plan, making sure you have the right investment strategies so they have time to work so that it serves you. back to agency again. It's your life. It's your money. Understand this stuff and understand how it's matched up.
Yeah, like I worry sometimes, like we could seem like professors on this, like saying, oh, this is, obviously you should do this. Like this is really, really freaking hard to do. Like for us, for everybody, this is really hard to do. To really think about things over that kind of a long-term period is really hard, because not only do you have like whatever you're doing can, deviate from the market and struggle, but at those times you got all kinds of people talking about the world's different because of this and the world's different because of this and this is over and you shouldn't do this anymore and your 60-40 portfolio is never going to work again. And so it's like this big emotional thing while this is all going on. And so this is really hard. I mean, I struggle when I construct factor strategies to think about this, to really truly think long term, because I get trapped in, oh, this person who I respect has said, this isn't going to work anymore. And like, you have to balance those arguments. So this is really, really hard to do, but it is something, at least if you think about it, at least if you're aware of this, if you don't go in here, if you don't go into the value strategy thinking I'm going to judge this over 3 years, or at least you try your best not to judge it over 3 years, I think all of this is incremental. All of this is trying to get a little bit better here and there. It's not thinking about like even me or anybody who study all this stuff sits in here and says, I could care less about 3-year performance. I'm not going to do anything. I'm just going to sit here. Like I get affected like it. I mean, you probably do. Everybody does. So it's just about trying to do your best and trying to keep this in the back of your mind as you make decisions like that.
Keep asking yourself, why do I think this is so? Why do I think this is real? Why do I think this matters to me? No, it's going to get questioned. But this is the beauty back to keep it simple, stupid. This is the beauty back to saying if stocks go up because earnings go up, am I broadly exposed to a bunch of stocks that earnings on average have been going up? So even if I'm in a period where it kind of sucks, do I kind of have something I can look at and go, well, do I still believe that, my favorite example, do I still believe that McDonald's is going to figure out how to price a Big Mac and a Chicken McNugget to turn the lights on tomorrow? And if I do, that next dollar at the beginning of the pandemic or in the middle of the financial crisis is probably going back into stocks, because I still believe that that's something that enough people depend on being true that it's going to be so.
What do you got for a song?
Firehouse off the debut.
I don't know that
which
one
is this is a deep cut. Well, maybe not too deep of a cut, but it's basically a knockoff. The real deep cut is there's this Move Fire Brigade song that is really great too. That's kind of a knockoff of it, but it's this idea of tempo. So this is Kiss figuring out who they are, what they sound like, what they want to feel like, and it's just enough like copying what somebody else is doing, just enough making it yourself and making it your own, and just enough like operating at a tempo that most bands outside of the Rolling Stones and some of these 60s acts and what they were knocking off is not going to do. It's not the fast stuff. It's not playing a metal song. It's way, way before like punk is really happening. And it just is like in a great groove. Wonderful song, Firehouse, matching up those time frames. That's what it's all about.
So number 6 is look to history for guidance. And I think this is a really important one. And we talked, this came up in the conversation with Rick where we were talking about this idea that fundamental investing is dead now. And we're not going to, you and I, we did a whole episode on whether fundamental investing is dead. So we're not going to get into that now, and people don't want to listen to us for 3 hours. But the general idea is, whenever I hear something like that, and we just talked about this idea that this time is different, it's always good to look back to history and say, are there parallels I can look at? And Rick went back to the 90s. And a lot of people were talking about fundamental investing is dead then too. And that obviously fundamentals had a big run where they came back. And that doesn't mean we're going to have a run this time where they're going to come back. But what it means is when I'm putting together all the information in terms of determining my opinion on whether fundamental investing is dead, I need to go have that context of history to bring in there. Because otherwise I can get trapped in all these people that are saying it's 100% dead and I should do this and I should do that. Like, I think it's important to, and it's not just the history I've seen myself, but it's the history of the entire history. And that's another trap people fall into, is history basically for a lot of people starts the day they invested their money in the stock market because they actually experienced that stuff and there is no other history. So I just think it's always important to look to history. Whenever you hear anything about anything, look to history, say, not history is going to repeat itself, but can this inform my opinion about what's going on right now?
Look at history and look at a sample too. Look at the 1990s, look at the 1890s. Look at the 1890s, go, I know the data is not that great. Let's look at the 1890s and talk about with the data not that great, does this inform anything in what I'm doing today? Skip around, look at different periods of time. And I think, I know we're going to touch more on this in a couple of points, but what you said about the data is bigger than your experience with the data becomes a really, really integral and important part of this year. We have to be able to step back, zoom out, see this as just one instance in a way broader context and understand how that's going to work, you know, hopefully for us, and make sure it's working for us. We got to ask those questions.
Yeah, what's it? This seems like a tough one to come up with a song, but I'm betting you did it.
I did. And the song I picked for looking to history for guidance and looking to a time period was, I picked I Was Made for Loving You. And that's, let's be honest, that's a disco Kiss. And it's a great song, but it's a disco song. And it's basically them saying, we're going to take our format and the way we do our thing, but we're also going to take something else that we know works and we know it works well. And we actually understand fundamentally why this thing works. And we're not so big that we can't cop this other style to make a friggin' hit song. I'll stand by it. This is actually one of my favorite Kiss songs. I don't know why I have such a soft spot for this one, but I Was Made for Loving You. Definitely an example of knowing how to cop something from history and apply it to what you're doing.
So yeah, our next lesson, I think this is an interesting one because I think there's two different ways to look at this. And obviously Rick talks a ton about fees and reducing fees, and I think he's right about that completely. There's two different ways to look at the fee argument. One is basically, it's very hard to predict what's going to work in the stock market over time. And so even if I've got like the active strategy, you know, the manager that I think is going to be great and he's charging me, you know, 1% or something like that, I don't know for sure if it's going to work out. So my best thing to do is just focus on keeping the fees down and not trying to make that decision. Obviously, the other side of that argument is if I can invest in the medallion fund or whatever, then I shouldn't give a crap about the fees because the net of fees, they're doing so well. So there's really two sides to this. And I think it's an interesting argument, but I think ultimately the idea that you should be paying attention to fees and that it should be an important thing in your process is absolutely 100% true, no matter how you think about it. You know, if you're one of the people that thinks about, well, I want to think about my return after the fees and I have high confidence in this, or if you're somebody who thinks I can't predict this, so I just want to focus on the fee like as my primary driver, I think either way, what Rick is really right about is there's so many things out there that are charging very high fees that aren't delivering value for those fees. And so that's why I focus on fees, I think is really, really important for investors. And I think this is a service Rick has done to people is Rick really gets you to focus on this idea, like I should constantly be thinking about these fees because so many of the things out there are not delivering on their value proposition.
Price is what you pay, value is what you get. Simple as that, and simple as stepping back from it and just really asking about that value that you get. I think this also maps really interestingly over this agency issue we talked about before, and it works with anytime you have an individual investor and an advisor, an allocator, or whatever. When you have two people who are trying to do something that is mutually beneficial, you have to have this fee conversation. You have to understand basically what is the value being provided to me. And in many cases, it might be something that's actually hard to completely value or perfectly put a number on. So whether that's mapping it against like the time that this is saving, the actual steps of implementation, in many cases, I think most of our job for both of us on two different sides of the equation in many cases is just like education. It's just giving people time and space to talk through something so they can educate themselves, so they can understand it, and then have a way to think through it. These are like finance is full of abstract concepts. So fees being part of that abstraction, because as Rick says multiple times in the interview, like advisors and people sell complexity. They sell complexity without the education component. They jack it full of fees, and then you're not getting the value of anything they have to offer. You're paying the price for basically them selling you complexity without the explanation. What we're really trying to get after here is, and what you just said in your point, is chase that fee down, chase that value down, and understand the ways that you're going to evaluate it that makes sense for you, and always understand why the person across the table from you, why this makes sense, not just for them, but for your best interest. Have to ask that question all the time, especially in an industry that mostly prioritizes the scale of the entity on the other side over the experience of the individual consumer.
And some people take Rick's arguments too far, even further than Rick takes them, in that, like when we talked to Rick, he was talking about the idea of like a small cap value fund is okay in your portfolio. You want to have the cheapest small cap value fund you can have, but guess what? A small cap value fund is more expensive than the S&P 500. So it's not as if I have to invest in the S&P 500 no matter what, and anything that has, 10 basis points more than the S&P 500 is horrible. That's not the case he's making. Like the case he's making is when you focus on fees, you're typically going to do a lot better. And if you're going to pay even a little bit more, make sure you have confidence that there's some value associated with that. So, people think like Rick was talking about factor investing. Like some people think someone like Rick would never endorse factor investing under any circumstances because it's this higher fee thing, but that's not right. I mean, Rick will, like with a small portion of your portfolio, he's talked about how he's done this. He's put some money in something like value. So it's important to not carry it to such an extreme that it's like, that it's like, no matter what, I'm focusing on fees, or it's important to not carry it to such an extreme that you're like, well, this fund is 1 basis point cheaper than this other fund, so therefore I have to invest in this fund. Like there's a point where the difference in fees is so little that it can't be a primary driver of what you do. So fees are incredibly important. Everybody should focus on them, but you also have to be careful that you don't carry it too far.
I love that, like the basis point and splitting hairs piece. Because again, it's like, how much time are you going to spend splitting that hair? And then it's not just about evaluating the fund. And granted, if you're going to do that and then stick with it for 30 years, like, yeah, the basis point, the single basis point even, can make a positive difference. But your own time and how you think about this stuff has to be a part of the equation too. And the reality is most people aren't as excitable about this stuff as we are. They're excitable about things like, you ready for the song on this one?
Yeah, let's do it.
Baby, if you're feeling good, and baby, if you're feeling nice, you know your man is working hard. He's worth a deuce. Deuce is definitely the song for this one. You got to make sure he's working hard. You got to know the value. You got to know what you're getting.
So our next one, we're only got 2 left, Matt. So we're actually cranking along pretty nicely for us. Usually we ramble on for like 3 hours about this. So we're off.
I'm making you take this to 10. You're not going to stop at 9 on this one.
Well, I've actually got a little bonus I want to talk about at the end anyway. So we probably
we'll go to 9 with the bonus.
We'll drag this on this.
I'm into
with It's what we do. Yeah. So number 8 is history is more than we have each personally experienced. And I think this gets back to what I sort of alluded to before, but I bring in the part we were talking about with international investing with Rick. There's a lot of international investing has struggled for a really, really long period of time. And so you have this balance of, I have my academic argument that international investing works, but then I have my real world experience where it hasn't worked. And, Rick comes down on the side of, you should have international exposure in your portfolio, which is what I come on the side of too. But that's a very challenging thing. Even Bogle, for instance, was kind of a believer that, I can get everything I need in the US. I don't need the international. Like a lot of people who we think are really, really, really smart. I think Corey Hofstein, endorsed this to some degree, is like the idea that you can get a lot of what you need in the US and you might not need the international piece. So there are very, very smart arguments on both sides of this. But one of the challenges, regardless of which arguments you believe in, the idea is most of us in our investing careers have mostly experienced the international does not work. That the great tech companies are in the US. All you need is the US. That's going to work out great for you. The reality is at some point we're probably going to experience a period, potentially a very long period, because this is how this has typically worked in history, where maybe international does a lot better than the US. And we're going to have to challenge our beliefs in that. It's important to kind of say, not just what I've experienced, but the entire thing. I don't think there's a right answer. I mean, I think this is, we're splitting hairs to some degree. If you're invested in the US total market, you're probably going to do fine. If you're not judging it behaviorally against the world index or something, you're probably going to be okay. But I'm still a believer that there is a strong case for international investing, and you have to go beyond what I've seen in my career to some degree to get that case.
Everybody remembers their first bear market. Everybody remembers their first horrible investment, or their third, or their 17th. I remember multiple of these personally for all the good reasons. And we remember that, and basic behavioral psychology, we remember the bad stuff more than we remember the good stuff. We emphasize the recent over the stuff that's further in the past. We emphasize the things we can see over the things that we can't see. This is why reading Kahneman, Tversky is important. It's also why reading Aaron T. Beck is important too. But that's a topic for another podcast episode. This idea that we're going to overemphasize things in our experience, that our personal experience is just one instance in a much broader reference class, that's the lesson here. Diversification. I love the diversification means you always hate something in your portfolio. That's the ultimate diversification test. This is kind of like what we're talking about here. Think broader in time than your experiences. Think broader in time than what your understanding of something is and why. And at least, Rick Ferri again, hold the mirror up, see if you agree with this or not. And if not, come up with your reason why. in my case, from personal experience on this thing, with clients and with myself, I know that it's easy to pigeonhole into comfort, into stuff that's worked for us and has worked well for us, especially in the recent past. It's really hard to zoom back out and say like, okay, yeah, I probably just mostly got lucky. I was halfway in the right place at the right time, but luck took care of the rest. I'm not actually that smart. And oh, by the way, this other thing tends to work over the long run. Maybe it doesn't seem like an obvious opportunity right now, but I shouldn't overlook it either. That's a really, really powerful thing to say.
And also on the other side, even if the international arguments are very strong, this goes back to the invest what you believe in thing we talked about before. Like if you're an investor who's judging yourself against the S&P 500 on a regular basis, like you may very well be better off without the international diversification. Because when you have these long periods where international struggles, the S&P 500 is your benchmark. You're going to be dragged down against the S&P 500. You may panic and, you may sell the international stuff at the wrong time. So again, like in theory, international investing is something I think people should be doing. But in practice, it really comes down to, do you believe in that enough to sit through the periods? If you're judging it against the S&P 500, where it's dragging you down against the S&P 500, if you don't, then you are better off just being invested in the US and not worrying about the international diversification.
I promise to limit my takes mostly to KISS, but the thing on this that I keep thinking of all the time is basically the way people like diversify their diets or diversify the places they go out to. And I think of this because of the area that I grew up in. Growing up, it was predominantly Italian restaurants. Like we have lots of really, really great Italian restaurants in northeastern Pennsylvania. And then there was a smaller subset of like Polish food, which is very similar. And then a very small subset of basically like a broader palette. Since coming back, there's all these options. There's still lots of people who will only ever go to their local like Italian, Irish, or Polish bar. And it's like, we have a friggin' amazing like Asian fusion place down the street that does like awesome like sushi and a bunch of other stuff. Wonderful Indian restaurant downtown. In fact, there's like 2 good Indian restaurants. I just found a Peruvian place the other day, just driving to pick something else up. Like diversification happens in all different parts of your life. And there's some fun in exploring. There's some fun in going outside of your comfort zone. But if you're my grandmother, who probably isn't listening to this, but if you are, hi, Graham. We talked about that text message you sent me when the banks were collapsing. They didn't collapse. You got a very limited palette. Like, she's not going to get outside of that comfort zone, and that works for her, and that served her well. And I appreciate her love for a McDonald's chicken nugget, and I appreciate her loyalty. And that's the way McDonald's keeps the lights on. So, steering back into my lane, my KISS song for this one. Are you familiar with the very polarizing KISS song, Beth?
No, actually I'm not. I probably should be familiar with that one, right?
I mean, so I have to say this with respect. My wife, Val, loves the song Beth. Very important song to her. I don't understand why. My very dear friend, Mike, who probably is the person who converted me more than anyone else into being like a wholehearted, like you really have to respect KISS on another level in college. He gave me this education on really paying attention to KISS, not just the stuff that I got from, my dad and my uncles and some of the other people that put me onto him. Beth is the ballad. Peter Crisp, he writes it, he sings it. It feels so out of place. It feels so weird to me, but you cannot deny it's their highest charting US single. Like, it makes no sense in the catalog to me. It's not the song I'm ever going to put on in a moment, but it's their best single. So take with that what you will. Your experience, your history is not the experience of other things. Sometimes you just got to be open to this stuff because weird stuff happens, like Beth being apparently one of the greatest KISS songs ever, according to the charts.
So our last one, number 9, before we talk about the bonus thing, is if it seems too good to be true, it probably is. And this is, I freaking hate ESG. And this is not like, and that probably is, that's probably too aggressive of a statement, but let me explain behind the scenes what's going on. So I don't hate ESG in terms of a concept. I don't hate ESG in terms of, well, if you want to invest in things that are doing great for the world, you should do that. I think that's awesome. What I hate about ESG is, like, coming from my factor world, this idea that you can have your cake and eat it too. And so many people, they're not anymore because it's not working anymore, but when it was working, this whole idea that I can invest in these great companies that are doing great for the world, and I'm going to get a better return than everybody else by doing it. And that's not the way it works in the real world. Like, if you want to get a better return, you're typically doing something other people don't want to do. You're typically buying the tobacco and all this other stuff that's doing horrible things for the world. And I'm certainly not endorsing that, nor would I do that myself. But that's the idea, is like, The idea that it seems too good to be true, it probably is. And, Rick was very anti-ESG as well. But you want to ask yourself that question, because when you're being told, this is great, I'm going to do great things for the world, I'm going to get great returns, and this is all going to work out in the end, it usually ends badly for you. And so if you want to invest based on ESG, that's awesome. If you're going to be more likely, going back to our behavioral point, to stick with a portfolio that doesn't have stuff in there you don't like, that's great too. But just understand the reality of what you're getting into, which is I'm probably not going to get, a return 2% better than the market over the long term by only investing in these great companies that are doing good for the world and excluding all this other stuff. That's probably not going to work out for you.
This is when we crop in the video of, Jack Forehand lighting his cigarette off the piece of coal that he just strip mined.
I've never actually smoked a cigarette, but I maybe for the episode, I'd have to figure out how to do it and make a run at it. But
I'll find a piece of strip mine coal from laying in the ground somewhere outside of my house, because I'm sure there's one there, unfortunately. So I'm with you on this. I hate something that can't be quantified to a point beyond just pure story. I do believe, so I'm going to take the softer stance on this. I think there are ways to define ESG, socially responsible, and more to a degree impact than anything else, where you can say, like, here are some standards I want to hold for something I can believe in. And I think that that's fair to the extent that there are certain things that certain people just want to avoid, because the act of owning a company is the act of helping determine and set some of the cost of capital for that company over the long term. And if you think the mining company should have a higher cost of capital, then one way to potentially have your small, tiny incremental vote contribute to them having a higher cost of capital is refuse to own them. So I believe in that. I just think it's hard to do in practice. And I also get personally very upset when I see the way a lot of these things are marketed and positioned, because they're preying on people who in many cases aren't going to do the math about it. And that's unfortunate. That's upsetting. You should know better firms selling this crap.
Yeah, I don't think people shouldn't invest based on ESG principles. If that's something you believe in, then I think 100% you should invest based on ESG principles. But to your point, one thing you have to be careful about is the big asset managers that are defining ESG for you may be defining it in a different way than you think. And that's one of the things you see with like direct indexing, and what O'Shaughnessy's doing with Canvas is like this idea of maybe I should be able to define ESG in my own way. Maybe that's a better way to do it versus like deciding, ExxonMobil is a, oil company, but they're also investing in these other initiatives. Like, what are they in terms of ESG, or what are these other companies? Like, it's a very, very difficult thing to figure out. And also, like, what's bad and what's not bad is in the eye of each person. Like, some people would carry ESG to a very extreme level. Some people would carry it to a much more, less extreme level. So I think a lot of it is a personal thing. But like you said, with anything in investing, if anybody can make money off it, they're going to try to make money off it. And so you end up with these products that are ESG more from the perspective of marketing than they are ESG from the perspective of ESG. It's more like everybody realizes, oh, people want to invest based on ESG, so I'm going to create this product for ESG. And those are not the greatest things to be investing in. And the only other point I'll make before I throw it back to you on this is there are a lot of factor people like me who have looked at ESG and maybe thought about ways to use factors in there to maybe make the drag you would get from a return perspective because of ESG less. So this is not black and white, like full ESG and zero ESG. There's things you can do behind the scenes where you might say, like, I'm going to couple ESG with these other things, or I'm going to make some portfolio construction decisions where maybe I can get my ESG if I believe in that, but I can do it if you're a believer that there will be a performance drag associated with it, which I think there's ways you can minimize that over time by maybe thinking about other things you're doing in your portfolio with it.
And it's also fascinating. This is, without turning this into a breaking news episode, this gets into all the layers of this stuff. Because if you have a bunch of fund managers who are saying, here are our more qualitative or more quantitative ESG metrics, then inevitably you're going to have companies who start to say, what are ways I can game those metrics? This is where we get a lot into like the dark side of like DEI and the dark side of ESG and the dark side of things like this, where it's stories on stories that are trying to gain metrics to basically market to a specific audience. And that's where you have to see all prior points. Agency for yourself and your own decisions. You have to know what matters to you, play an active role in expressing what matters to you, and play an active role in vetting. If you're going to have somebody else allocate money for you, if you're going to build stuff with somebody else for you, make sure you're building it with them. if you're going to never blindly accept something, do some research, do some due diligence. If you find something that rhymes with you, your agency, your decision-making process, that's okay to get behind. And there's plenty of ESG funds or things in the theme of impact or in the theme of stuff that actually aren't terrible funds. They're good, full-hearted fund managers and people putting this stuff together. If there's sympathetic values to you in their situation, that can be a really good choice. I'm a huge believer in thinking of smart ways to implement these strategies and just steering around what, unfortunately, the explosion in ESG over the last, call it like almost 15 years now, has just produced a lot of like drivel and unfortunate marketing and kind of a cash grab for people going like, oh, I can sell more product if I say the story just this way.
So what song you got for us?
Hotter than hell. Because this is just a metaphor that it's all marketing. It's all metaphor all the way down. Hot, hot, hotter than hell. You know, she's going to leave you well done. Hot, hot, hotter than hell. Burn you like the midday sun. She's not actually going to burn you like the midday sun. That ESG fund still might own a bank that's financing the oil and gas industry. And just because you've avoided direct fossil fuel companies doesn't mean you're not actually lowering the cost of capital by playing with their financiers. Look through, people. Hotter than hell. Yeah, there's a dark side to that heat.
So just one other point before I do my little bonus thing here is the other point Rick made, which I thought was a good one, which you could certainly argue that if ESG is what you believe in, maybe like donating money directly to what you believe in might be a better way than adjusting your investment portfolio for that. No, we don't have time to get into all the arguments with that, but I thought that was an interesting point to think about at least.
Not only a brilliant point, a really impactful point, because that can be manifested in ways where you have direct impact. The rule that allows you to make charitable distributions for your RMDs from your retirement account. So you can do a required minimum distribution if you're at requirement distribution age. That distribution, if you do it in a very particular way, talk to your advisor, talk to your accountant about this stuff, you can make direct payments to charities. A number of clients who over the years, whether it's into a foundation or to direct charities in their community, they might have ESG beliefs. They might have things that they want to support, but now in an IRA, you don't really have the embedded capital gains issues, but there might be reasons that it's hard to get away from that. You know what one of the best ways to get away from that is when you take money off the top, when you make a donation, you take the McDonald's shares that you think, if you thought McDonald's were the devil, you can donate them to a church, tax-free, or you can donate it to a charity of your choice, tax-free in many cases, as long as they qualify. You can take that RMD money, you can give it to the local women's shelter. You can do a lot of good with money on a more localized level than your teeny, tiny fractional ownership in some gigantic conglomerate is going to move the needle on. You can also vote your proxies too. A lot of nuance to that. I appreciate you highlighting how much nuance is there, because that's part of the conversation we try to have with clients too.
So we spent 95% of this episode agreeing with Rick. Let's do a little disagreeing. Because I think this is really important. Like, and we'll do these episodes about other excess returns podcasts as well. But the idea is all of us, need to have our own opinions, and we need to think differently through these things because that's how we learn. And so the one thing I did disagree with him on is this idea of Mike Green's work around the idea of does passive investing influence the market? I mean, I think Rick largely believes that's not true. I'm a believer that as money is flowing into passive funds, I do believe that like the liquidity of these largest companies is not scaling with the market cap. I do believe there is an influence to that. I don't think it's some massive influence. I think it's just this slight upward pressure that sits on there all the time. But I do think that's something for all of us to think about going forward, like as we analyze the markets. But the interesting thing for me, going back the other way with this, is regardless of your opinion on that, it's interesting. Like, so you could take Rick's work and you could say, you know what I should do? I should buy an S&P 500 fund. You know what happens when you take Mike Green's work? You also should buy an S&P 500 fund. So it's interesting, like we can disagree on this, but like the practical implications for investors, they aren't really there. Because if you believe that these big companies are getting driven up by the flow to passive, well, then you want to own the big companies as they get driven up. Now, there's other catastrophic stuff Mike talks about how it might end eventually, but in the shorter term, the medium term, like I think Mike's a believer, you should own the S&P 500 fund. So is Rick. So it's one of those things where you might see like Rick Ferri and Mike Green is like in complete opposite on this, and they are, but the practical implications are actually the same. So that's why I think it's important to like kind of look at both sides of these things, because you might end up in a better place where you realize, oh, I can look at this. It's very interesting to talk about, but in terms of the implications for my portfolio, I might end up in the same place I started.
I love that you put the connection there. And I think it's also important. And this is one of the great pleasures of participating in conversations like this and you guys recording the podcast and sharing this, because you can look at Rick Ferri next to Mike Green. You can let both of them into your head. You can put both of them. You can have two mirrors, people. You're not just excluded to one mirror. You can have two mirrors. You can look at both of these things, two dark mirrors even, and you can see what they're saying about this. We won't quote the stat that Rick Ferri used, and I'm not capable of quoting the stat that Mike Green uses either. But like, passive is a bigger thing than it used to be. Active is a smaller thing than it used to be in the way we think about it. That has intraday and daily liquidity things that it's creating, that has medium and longer term other things that it's creating. These are bigger problems. These are market functioning problems. But the end result is basically there's still a lot of money that needs to get put to work. Company earnings are still going up. And we still kind of need this thing of, this is part of investing in our future. This is how capitalism works. Hopefully not how capitalism breaks, but at least for right now, a big part of that takeaway, to your point, is not such a bad thing to own an S&P 500 fund for what? Couple of bips?
Yeah, it's an interesting thing to think about. And I love, that's part of why we do the podcast, is to be able to think in real time about these issues and the different sides of them. But again, like, it's also important to break it down to what does it mean for someone's portfolio. And I don't think these arguments mean much for someone's portfolio, because even at both extremes of it, you kind of end up with the same conclusion in terms of the investment implementation. So it is something I disagree with Rick on, but I don't think it really has many practical implications, because you end up in the same place.
Couldn't agree more. You end up in the same place, whether you think it's a slight falsehood, a complete lie, a travesty, a scam, whatever else. I got to take you, the 10th song on my playlist, rock and roll all night, because think about it for a second. I want to rock and roll all night and party every day. That sounds great in theory, but in practice, Jack, could you rock and roll all night and party every day? Can you hang at this age with that?
If there was someone who could do it, it would not be me, Matt. I don't think anybody could do it, but I would not be the guy that could do that. You would be able to do that way more than I could.
Yeah. Maybe Matt at a younger age who could still pull all-nighters. I can definitely not pull an all-nighter anymore.
You did actually rock and roll all night and party every day at one point, didn't you, back in the...
I did, but even then it had limits, and I am here to tell you those limits have dramatically constrained themselves. I really like going to bed with the sunset and getting up with the sunrise these days, and I am not farming. The rock and roll all night, party every day idea of, hey, keep it simple, stupid. That's not a realistic lifestyle, but it is a really great way to package up music and sell it to teen and preteen boys with, your face makeup and your lunch boxes and all your other things. So all these guys, all the stuff, keeping your agency, understanding their agency, understanding that you can still go see Kiss play and have a pretty damn good time, especially if it's in the mid to late 70s. That matters. That experience with these things matters so much. And it's always fun to have a little fun with this. Keep it simple, stupid. Rick Ferri is a brilliant thinker, and I so love just the mirror that he holds up with such great clarity to allow people like us to reflect on what we do every day with clients for a living. He's got a wonderful clarity of thinking that he brings to the table.
So I think that's a great thing to wrap up on. The one thing I'll say before we close is we definitely want feedback on these types of things. We're trying different things. We're trying this thing on, lessons from some of the excess returns episodes. Like, if you have an opinion one way or the other, you can email us at excessreturnspod@gmail.com. You can make a comment. If you think this is a good thing for us to do in the future, you can like it on YouTube. Just anything you can do to give us feedback. We were interested in, obviously we want to talk about things we're interested in, but we also want to talk about things the audience is interested in well. And so we want as much feedback as we can get.
What's going to happen here is I'm going to have to dig deeper into my very limited Kiss knowledge because, I don't know, Gene Simmons didn't pay his taxes or something like that is going to be the horrible undirection. So this is your job, dear listener. Please give us emails or comments. Tell us what we can do with this, because this is fun. And we're trying to broaden this conversation around stuff that, like, this is part of our actual everyday. Apparently it's interesting to some of you. That's really cool.
Well, thank everybody for joining us, and we'll see you next time.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbino, and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.